Welcome to Talk Tickers. Today, January 9th, 2026, we are launching into a financial event that has, fundamentally redrawn the map of the $50 billion North American collision repair industry. We're doing a deep dive on a massive market reshaping acquisition by Boyd Group Services.
Yeah, and this is so much more than just a big purchase. This is a strategic checkmate. Boyd Group Services, that's the parent company of Gerber Collision and Glass, just closed on its acquisition of Joe Hudson's Collision Center, JHCC, for a massive $1.3 billion.
$1.3 billion.
So our mission today is to really dissect the colossal scale of this thing, understand the pretty genius financing that made it happen, and then explore what it all means, for the new combined company and for the intense pressure this puts on the market leader, Caliber Collision.
Okay, let's unpack this. We're calling this the Talk Tickers edition because the tickers and the financing are just so central to the whole story. Let's start with the deal snapshot. What happened today?
Well, as of today, it's a done deal. Boyd Group Services has officially acquired Joe Hudson's. This is, I think, arguably the largest M&A event in this sector since Crash Champions and Service King merged back in 2022.
So let's talk numbers, the valuation.
That's the place to start. Total price tag came in at approximately $1.3 billion US dollars. And to get your head around that number, you have to look at JHCC's metrics. They reported $722 million in annual revenue and about $63 million in adjusted EBITDA. That's for the 12 months ending mid-2025.
So doing the math on that, we're looking at a valuation multiple of about 9.3 times EBITDA after you factor in synergies?
That's right, about 9.3.
That sounds rich. For this industry, that's a pretty high multiple. What makes JHCC so valuable that Boyd was willing to pay that kind of premium?
Two things, really. Scarcity and geography. JHCC was one of the last big, high-quality MSOs, that's multi-shop operators, that hadn't been snapped up yet by one of the big five. And critically, this deal adds 258 locations in 18 states with a huge concentration right in the high-growth U.S. Southeast.
So they weren't just buying shops.
No, they were effectively locking Caliber out of a prime expansion territory.
That immediately changes the leaderboard then. What does this do to Boyd's overall footprint in North America?
It's a dramatic and immediate change. The acquisition boosts Boyd's total footprint by 25%. It brings their total to 1,301 sites. So they are now, without a doubt, the number 2 player. Still a gap to close with Caliber, who's, hovering around 1,800 locations, but a much smaller gap.
Okay, and this is where the financial strategy gets really interesting for me. How does a Canadian-listed company suddenly find $1.3 billion US dollars for a deal like this, what the street is calling a triple play funding mechanism?
It was surgically precise. It was brilliant. They leveraged their existing financial stability while, at the same time, broadening their investor base.
Yeah.
So 3 parts.
Yeah.
First, they did a debut U.S. equity offering, an IPO, raising a stunning $897 million US dollars. That also got them listed on the NYSE under the ticker BGSI.
So that's the big chunk of flexible capital right there.
Exactly. Then part 2, they added a private placement of $525 million in Canadian dollar senior unsecured notes due in 2030. So they're leveraging their strong standing in the Canadian debt markets.
And the final piece.
They just tapped their existing revolving credit facility for the rest. The genius here is that they optimized the whole structure. They used U.S. equity to buy a U.S. asset and Canadian debt to get a better cost of borrowing. They built the war chest and deployed it before their competition could even react.
Let's zoom out a bit. This deal feels like the culmination of years of momentum in the sector. Why is collision repair such a magnet for these huge consolidators and for private equity firms?
It's all about the fundamentals. They're bulletproof. Think about it. Your car gets hit, you have to get it fixed. It's a non-discretionary service. The total market in North America is massive, $50 billion a year, and it's recession-resistant.
And it's still fragmented.
Highly fragmented. That's the critical point. There are still about 30,000 independent shops in the U.S. And for a big player like Boyd, 95% of their U.S. revenue is paid by insurance companies. That's guaranteed cash flow. PE loves that combination fragmentation plus stable mandatory revenue.
And JHCC, the company they just bought, was a perfect example of that PE-fueled growth.
Absolutely. They were founded back in 1989, kind of a regional player. They only had 23 locations by 2014. Everything changed in 2019 when TSG Consumer Partners, a PE firm, acquired them. At that point, they had about 100 locations. Under private equity, JHCC just went on a tear, a blistering growth strategy. They hit 250 locations by the end of 2024 through acquisitions, through building new sites. I mean, they opened 50 new stores in 2024 alone. That scale, that operational tempo, that's what Boyd bought for $1.3 billion.
But that expansion ran into some pretty serious headwinds in the first half of 2025, right? The environment right before this deal wasn't exactly smooth sailing.
Not at all. It was a really challenging environment for consolidation. We saw M&A activity slow down by about 35% year over year across the whole Big Five. And the big issue was rising total loss rates. The cost of parts, vehicle complexity, it all went up. So nearly 24% of claims in Q1 2025 ended up as a total loss. And shrinks the pool of repairable cars.
Yeah, that makes sense. So when Boyd themselves reported flat growth in the first half of 2025, that small deal they did in August for an 8-store operator in Virginia, that was a warning shot. It was like they were saying, we're pausing, but we are reloading.
And the JHCC deal is the detonation. And you have to see this through the lens of the competition. We know Caliber, the market leader, confidentially filed their S1 for a proposed IPO back in July of 25.
An S1, so that's the formal intent to go public.
Exactly. Boyd's execution here means they raised their capital and spent it before Caliber could even finish their IPO process and get their own war chest. The pressure on Caliber now is just immense.
And the end result is clear. The Big Five held almost 32% of the market by mid-2025. This deal just pushes that concentration even higher.
It does. So
Boyd paid a premium. Now comes the hard part. Integration and justifying that valuation to investors, they're targeting $35 to $45 million in annual cost synergies. I mean, given the complexity of integrating 258 shops across 18 states, isn't that target really risky? What are the pitfalls?
The risk is real, but I actually think the synergy target is pretty conservative for a deal this size. The 35 to 45 million will come mostly from enhanced regional density. When you have this many shops packed into the Southeast, you get massive procurement leverage on paint, parts, materials. You optimize logistics. You get more efficient with insurance relationships. The biggest pitfall is probably just management bandwidth. Can they integrate JHCC while also driving their big internal cost plan?
And that internal plan is Project 360. This seems critical to showing the market they aren't just buying growth.
Exactly. Project 360 is the core of their margin expansion plan. They're aiming for $100 million in total cost savings over the plan period. And we've already seen it work. For instance, they changed their indirect staffing model in April of 25, basically optimizing administrative and non-repair staff. And that alone delivered $30 million in annualized savings. So they're proving they can do it.
So where does the rest of that $100 million come from?
They expect another $40 million in savings by the end of this year, 2026. That's mostly from leveraging their new, bigger scale to get better prices on everything they buy, direct and indirect. This is just management being laser focused on turning size into profit.
This is where the evolution of the service itself comes in too. We're not talking about just banging out dents anymore. We're talking about repairing a supercomputer on wheels. The move toward things like mobile auto solutions, MAS, and especially calibration, that seems key to getting higher margins.
It absolutely is. Calibration is mandatory for any vehicle with ADAS advanced driver assistance systems. So that's your lane keep assist, adaptive cruise control, all that stuff. Right now, calibration is only about 5% of Boyd's total revenue, but their target is 10%. And the reason it's so lucrative is that when you perform calibration internally, it's a pure labor operation. And labor is their highest margin category.
So the goal is just to cut out the middleman.
Precisely. As of Q3 last year, 28% of their calibration work was outsourced, a sublet service. That means they were paying a third-party vendor, which is their lowest margin business. So now they're actively internalizing it, aiming to do 80% of it in-house within a year or two. That shift turns what was an expense into a high-margin revenue stream.
So if they pull off Project 360 and successfully integrate JHCC, how quickly does this change their whole trajectory?
This deal massively accelerates their progress toward their 2029 financial targets. They're aiming for over $5 billion in revenue and over $700 million in adjusted EBITDA. So that's targeting margins of 14% or more. And, the company has already shown it's resilient. They got back to positive same-store sales growth in Q3 of 25, and their EBITDA margin climbed back to 12.4%. This acquisition isn't just about getting bigger, it's about profitable scale.
All right, time for our segment where we explore the most aggressive strategic conclusion from all this. So we've established Boyd pulled off a complex capital raise, deployed $1 billion+ to lock up the Southeast, and secured huge scale and synergy potential.
Right. The acquisition makes Boyd dramatically stronger, but it also places extreme, I'd say almost existential, pressure on Caliber. They have to deploy their own IPO money effectively now and justify their higher valuation. The clock is ticking for them.
So what's the outrageous but plausible trade idea that comes out of this analysis, based purely on this massive shift in competitive pressure?
I'd say you initiate a long-short collision arbitrage strategy. You go long on Boyd Group Services, BGSI, or BYD. The rationale is pretty straightforward. Boyd has done the hard work. They secured the financing, they deployed the capital, they captured the region, and they've accelerated their own internal cost plan. The deal risk is gone. Now it's all about execution, which promises strong returns.
And the other side of that trade, the short.
Yeah, Short Caliber Holdings, Inc. The rationale here is that Caliber is now under overwhelming pressure to just maintain market share. They have to spend their IPO money, and they have to spend it aggressively. This raises the risk that they're going to overpay for their next big acquisition. And you have to remember, the pool of good targets just shrank dramatically with JHCC off the table. Boyd acted first, efficiently. Caliber now risks acting second and expensively. That would dilute the value of their own IPO. So when you boil it all down, what stands out to you as the single most critical takeaway from this deep dive?
For me, it has to be the financial sophistication. I mean, Boyd used a debut U.S. IPO alongside senior notes to fund a truly transformative deal. They added 258 locations. They consolidated the Southeast. The whole industry is now just unequivocally shifting toward national scale and ruthless efficiency, backed by plans like Project 360 and that key move to internalize high-margin services like calibration.
And that shift in scale, it leads to the ultimate implication we have to consider, which is leverage. As the Big Five continue to consolidate, they now control over 31% of all revenue in this industry. How much negotiating leverage will players like Boyd gain when they deal with the handful of national insurance carriers? Remember, those carriers provide 95% of Boyd's U.S. revenue.
That's a huge point.
The power dynamic is quietly but very rapidly shifting. Is shifting away from the payers and toward the providers. And that power struggle is going to define the next 5 years in this sector.
That potential shift in market power, all driven by superior scale and execution, that's the truly provocative thought for you to explore as you process this massive acquisition. Thank you for joining us for this deep dive into the world of collision repair consolidation.
And of course, the standard disclaimer. This analysis is based purely on available public information and our own strategic assessment. This is not financial advice. You should always conduct your own due diligence.